This is the part 3 video for basic accounting terms for beginners. In this video, we will be discussing about expenditure, types of expenditure, sales, purchases, accounts payable or creditors, accounts receivable or debtors, profit, income, etc. Expenditure. It is the amount of resources consumed. It is usually long-term, extends beyond the accounting period. To understand more clearly, let us go into the classification. Capital expenditure incurred to derive long-term advantage to the business, either to acquire asset or increase the capacity of business. See, when I told you fixed assets are meant to be used for more than 1 year or for a longer period. So capital expenditures are incurred to acquire assets which are meant for a longer period or to increase the capacity of the business. If a business is producing just 10 of their products, now they use it to produce 20 or 25 of them for a long period, not for 6 months or not for 3 months. It's for more than 1 year. Revenue expenditure. Revenue expenditure, it is when the benefit of expenditure expires within a year. Example, a salary wage. When the expense you take or the expenditure expires within a year, that is, if you pay salary, the next month you have to pay salary again. That is, the benefit of that 1 month salary is just for 1 month. And wage, again, for 1 day you can pay wage. And again, next day you have to pay again. So it is just for a shorter while. Loss, when liability increases over asset. So, like I mentioned before, liability is the money which the business owes to outsiders, and asset is whatever others owe to the business. So when you have to pay more than what you receive, it is a loss. And again, income, the increase in the net worth of the firm, either from business activity or other activities. The net worth of the business is the difference of assets and liabilities. If it is more, it is the income. Profit, the excess of revenue over expenditure. It leads to increase in capital. Profit is when the revenue or the income is more than the expenditure or the expense. It is a profit. And whatever profit a business earns will go into the proprietor's account, that is the capital account. Again, goods, commodities which are purchased and meant for resale. If a firm purchases things which are again sold in order to get revenue, it is known as goods. Purchases, the total amount of goods purchased on credit and cash which are meant for resale. They may be finished goods or raw materials meant for sale. Returns of goods to the supplier is known as purchase returns. The total amount of goods which are purchased, that can be purchases, can be again two types. Either they can do cash purchase or they can do credit purchase, but it should be meant for resale. And they can purchase it in the form of finished goods and then give it for resale, or raw materials which are meant for further production. If it is a company which produces things, it can purchase raw materials, produce, and then give it for resale. If it is just a wholesale company or something, just purchase finished goods and resale it to a retailer or something. And when the goods are returned to the supplier, it is known as purchase returns. Sales, the proceeds of goods sold or receipt of service rendered by the business. When the amount of money earned while the goods are sold or service is rendered is known as the sales. And it can either be, again, like we said in the case of purchases, it can either be cash purchase or credit purchase. Again, assets, any fixed assets which are sold cannot be considered as a sale or a sales, because it is not. Sales is only when the goods or commodities which are meant for resale is sold, not when fixed assets are sold. And again, when the customer of the company or the firm returns goods, it is known as sales return. Stock, the goods lying with business for sale for any given date. So it depends upon the time. Like when it comes to stock, what is the amount of goods or that is with the business at a given point of time or a date. When it comes to date, it is a stock. So the value of goods remained unsold at the end of the accounting period is the closing stock. The closing stock is the amount at the each and every accounting period ends at, for example, if it's at 31st March 2018, what stock is with the business on this date, that is 31st March 2018, that is known as the closing stock. Again, this closing stock at 31st March 2018 becomes the opening stock for the next year, that is 1st April 2019. This is a very important concept when you come into accounting problems, because one closing stock becomes the opening stock for the next year. Again, debtors or accounts receivable. A debtor is a person who owes money to the business as he has received some benefit from the business. The total amount is shown on the asset side of the balance sheet at the end of the accounting period as sundry debtors or accounts receivable. Here, a debtor is a person who owes money to the business. He has to give money to the business, therefore it becomes the asset to the business. Now, debtor is a person and he is an asset to the business. Debit is a aspect and debt is a liability. Debtor is a person, debit is an aspect, debt is a liability to the business. And again, here this sundry debtors are shown on the asset side of the balance sheet. The total of the debtors are shown on the asset side of the balance sheet under the name either sundry debtors or accounts receivable. Creditors or accounts payable. A creditor is a person to whom the business owes money as he has given some benefit to the business. The total is shown as sundry creditors or accounts payable on the balance sheet. If the business buys goods on credit from someone, the person becomes creditor to the business because the business has taken a benefit, that is, bought goods from the creditor. It is liable for the business to pay him the money. So the creditors or the accounts payable should be shown on the liability side of the balance sheet. This is my reference, Accountancy 1 by Dr. P.K. Lazar.